This episode was really inspired by one of our clients that we've worked with recently. They had some good questions regarding why we brought them into a particular market and why now I'm saying in that same market, do not buy, which was in one of the recent property market updates that we did a few weeks ago. No longer localized. You've got a lot of investors that are now buying in areas that they do not live, in states that they do not live. That hasn't always been the case, particularly, within the last 10 years, that has now shifted. Just very simply, when you're speaking with the agent, ask them the question, how much interest have you got for this property? How many offers do you actually have on the table just yet? Not every agent is going to be forthcoming with it. It's about how you frame the conversation and build rapport with the agent. But if you can do that, the agent will tell you. Hey everyone, welcome back to the Smash Property Podcast. I'm Nick V. This week's episode, we're going to have a chat about property market cycles. Now, fundamentally, this country has shifted in the way that it approaches buying property, specifically buying investment properties. Now, traditionally, the property market cycle followed a slow 18-year process where it would peak, it would decline or stagnate for a period of time, might even correct itself, it would bottom out, start to rise, and then boom and peak again. And that cycle, like I said, could take approximately 18 years to fully go through that entire cycle. Now, at the moment, with the advent of buyer's agents, buying has become clustered. It has become much more focused and centralized in specific areas, largely thanks to buyer's agents and largely thanks to data-driven investment decisions. So today we're going to unpack why, in my opinion, that market cycle shift has now changed, what to look out for if you are doing it yourself, and some other little helpful tips that will always help you along the way. Before we get into it, I got to say in all these episodes, this is not financial advice. I am a buyer's agent with a real estate license. I'm not a mortgage broker with a credit license, nor am I a credit representative. All of the information in here is educational only. Please do your own research before you go out there and buy a property. If you need help buying a property, that's what me and my team specialize in. There is a link in the description below where you can get in contact with us to see if we can help you on your property investing journey. Let's get into it. Now, firstly, this episode or topic really was really inspired by one of our clients that we've worked with recently. They had some good questions regarding why we brought them into a particular market and why now I'm saying in that same market, do not buy, which was in one of the recent property market updates that we did a few weeks ago. And I can understand why they had that question, but it really just got me thinking about the property market cycles, how quickly they now move and shift, and markets that are good 2-3 months ago do change and shift into being, in my opinion, overpriced markets where I wouldn't be necessarily looking to buy very quickly again. So let me just firstly start by going through the traditional 18-year property market cycle. Now, I know it is a fairly common, well-known sort of, I guess, I wouldn't call it a theory because there is a lot of data proof with the 18-year traditional cycle. But as I said, markets would boom, they would peak, they would then correct themselves, they'd go through a recovery phase, they would go through then another growth, and then obviously boom as well. Now that period of time, looking at historical data information is almost accurately to the year, 18 years for that market, for any market to really go through that entire market cycle. Now, this is really based on land values, land cycles, and population growth. And it's just so interesting that it's such a dynamic thing about property and prices and growth and, humans, that it is such a predictable cycle, or has been up to this point, such a predictable cycle. Now, what's really changed with that theory, I guess, or what was once that particular cycle, is now property is no longer localized. You've got a lot of investors that are now buying in areas that they do not live, in states that they do not live. That hasn't always been the case, particularly, within the last 10 years, that has now shifted. So you've got mobile investors investing where they can ideally afford and investing where their buyer's agent would be guiding them to go to. So there is a lot of now borderless investing going on in the country, which is a great thing. The difference also in the last 10 years is there is a ton of property content. There's just a ton of content in general going out online, whether it's podcasts like these on YouTube or Spotify, or little short clips on TikTok and Instagram and all those sorts of things. And I know not a lot of people base their decisions specifically on one podcast or one, little short clip, but people will follow, certain people. We have followers of this channel, for example, that follows of many other channels. And you would then start to frame ideas about what you see and hear, and then you would loosely base your decisions on that. That's just it's kind of like human nature, right? Like you watch something long enough, your ideas are going to start to be ingrained. Now, this is a great thing because information is much more freely available, but it also can be, I guess, a downside too, because you've got to be careful about where you get your information from. And I've said it on so many other podcasts, is don't just watch my content. Go and watch a bunch of other people with a bunch of different opinions. The idea being is that then you can form your own views and opinions on, okay, yeah, Nick said this, but I heard this on another podcast. Let me go and validate it somewhere else. And then you come back to baseline with what works for you, which is really, really important. The other thing too is we've got so many, access to data, tools, and information, which, 10 years ago, was available, but not as, frequently and readily available as it is today. Now, the major factor and the major thing that has changed within the last 10 years, really in the last sort of maybe 5 years, is the introduction of buyer's agents into the Australian property market. Now, I know buyer's agents have existed in Australia, 20 odd years ago, but they were not mainstream and definitely not as big on social media as they are now. And in my opinion, that is the fundamental change. And I want to talk a little bit about that. And I'm becoming ever more vocal about the buyer's agent industry. The longer I'm in it, the longer I see the practices of my peers in the industry and how they operate. There are some amazing buyer's agents out there, but a large majority of them, I've got to say, are absolute garbage because they have never bought properties of their own. They don't even have any investment properties. They don't inspect the properties. They haven't even been to the locations that they're buying. They've just done a course and now they call themselves an investment property buyer's agent, which is terrifying. So I always encourage you to vet the BA before you do any work. So with that, we've got demand now concentrating into specific areas and locations. It's no longer sort of evenly distributed across the country, right? Because what would happen is you've got, data tools that are all collecting the same data, right? Or near enough the same data and information. People are then paying for access to that data, and then they're basing their decisions on that data and the information, and then they're going into certain markets. The same thing with the buyer's agent space. Now, what I'm typically seeing in the buyer's agent space, and I've mentioned this on other podcasts, is you have the larger buyer's agents, and larger in the sense of potentially having a large following and potentially having a large client book. Now, the specifics with this is they take their large client book and they need to place those clients somewhere, right? Like I've mentioned before, 50, 60, 100 clients a month. That's a lot of properties to buy, and you've got to place them somewhere. Now, typically, they're going to have their data that they're looking at, their information, their agent networks, and they're going to concentrate their buyers into specific markets. Now, the other thing, what I see is you have the how do I sort of put it? The shit BAs, right? That don't want to pay for data, that don't want to, do the proper due diligence. They will just follow where the larger buyers agents are going, which I am seeing in so many markets right now. I saw it in Townsville. I never bought any properties in Townsville because I could see that these were extremely overpriced for what Townsville is and was. It's had a huge amount of growth, but that growth, in my opinion, is artificial. And I'm very interested to see the tail end of that on the new market cycle. Does it now plateau? Does it actually come back to baseline? What is it? No one really knows, obviously, until we get there. But you have big BAs buying, you've got the shit BAs kind of following suit, and the consequence of that is you've got a large concentration of buyers in specific areas. And so why is this a problem? I think it's a problem with, in a sense for buyers like yourself who might be watching this and looking to do something on your own, or maybe you're looking to work with a BA, is and this is where my client reached out previously, because we did buy in a Victorian market, which amazing deal, amazing price, bought it well below the median, all the fundamentals stacked up for that specific deal for that client. But then I was on a podcast saying, do not buy in that area, sort of a month and a half, 2 months later. And what I'm seeing is the shift in some of these markets, like Victoria's, a hot market where a lot of BAs are rushing into, and they're rushing into, the Bendigos, the Ballarats, the parts of Geelong. And what I see on the ground when I'm talking to agents, what I saw 2 months ago in Bendigo, Ballarat, was I was able to find deals. I could sort of talk with the agent with negotiating lower price points. That shift in a matter of weeks, literally, we were then not able to actually find great deals that we saw good value attached to, because the prices had jumped so much. The agents were getting inundated with requests and information asks from buyers agents looking to get into the market. And as soon as I'm not able to really negotiate on price, I'm pulling out of that market. And the crazy thing is how quickly that can shift and change. And it wasn't long ago, Perth was the big thing. We were buying in Perth and got some great deals for some of our amazing clients in Perth. But there was a point in time where I had to pull the trigger and be like, nah, we ain't buying there anymore, because the deals and the numbers just don't stack up. So this is why I think it's important to keep your finger on the pulse with this sort of stuff and the changes and the fundamental changes in the market, because traditional sort of buying and thinking still to a degree does hold true today, but we've also got new factors to really look at as well. So the result of all of this is you've got markets moving much faster than they used to, much faster in terms of price growth, much faster in terms of the mortgage to income ratio can allow for, much faster than a lot of the traditional fundamentals would really shift in a market. And this is, I'm not saying it's a terrible thing, but all I'm really calling out here is it's something that we need to pay attention to and factor in when we're looking at these new markets. And I'll just give you a hot tip. If you are looking yourself and you want to go down the route of finding and buying a property yourself, just very simply, when you're speaking with the agent, ask them the question, how much interest have you got for this property? How many offers do you actually have on the table just yet? Now, not every agent is going to be forthcoming with it. It's about how you frame the conversation and build rapport with the agent. But if you can do that, the agent will tell you, mate, like I've been inundated with 20 inquiries already. Most of them are buyers agents trying to scramble over this one property, right? You can get that information, again, depending on how you frame it. And if you frame it right, you can get a world of information from agents and property managers, and it'll tell you if you've got 20 offers on a property or 20 inquiries, what are the chances of you being able to buy that property at a really good price? Pretty much none, because in that scenario, the only one who wins is the person who wants to pay the most with the best terms. That's just the reality of it. And this is why, as a professional buyer's agent that buys investment properties, I'm shifting and moving, changing markets on a weekly, monthly basis, right? Now, again, just to reiterate, if you have bought into these hot markets, like good on you, you're riding the wave and you're going to reap the rewards of all of the buyer's agents scrapping over all these properties, which is going to inflate the price of your property. That's a great outcome. What I'm really saying is if you are entering into these types of markets, you need to be very, very cautious. I'm not saying don't buy there, like categorically don't do it. You just need to make sure that you're buying the right asset at the right price. And if it's an investment property, you do not want to be overpaying, because it is going to set your property journey back much longer than it really needs to. So the new reality here is we've got these micro cycles inside the macro cycle. So instead of that 18-year slow rise and fall where you can sort of, it's like a slow car wreck. It's probably not a good analogy, Nick. Property is not a car wreck, but you get my point, right? It's like a slow motion thing. If you ever actually have been in an accident, you know what I mean? It's like everything just slows down and you can kind of almost predict where you're going to land. That's kind of shifted and that's gone. Markets now surge within a matter of a few years, right? So, and again, let's take a look at Perth. Perth is pumping still, right? If you see my property market updates, it's got some of the highest growth in the country at the median level. But Perth went from a very, very low base, would have been a few years ago now, to a very high median in a very short, condensed amount of time. Why? Because we had this concentration of data, we had this concentration of buyers agents into those particular markets, and they then, the other side of that, we're yet to see it, right? Because in my opinion, Queensland and Perth were one of the sort of first markets in the last few years to really, I guess, be a beneficiary of this concentration of buyers and buyers agents. So we're sort of yet to see the fallout of that. And it's going to be very interesting to see where all of this stuff lands over the next sort of few years. Now, the important thing here is that market cycles, like I was just alluding to, is not just the Australian property market, where the Australian property market's just moving and doing its thing. Within Australia, within the cities, within the states, within the regional centres, they're all going to be moving differently on that market cycle. So, you know, it's very obvious Melbourne and Victoria as a whole has been flat for a very long period of time, like Perth was for a very long period of time, like Queensland was for a very long period of time. And then both Queensland and Perth now have had their sort of booms or their rapid increases in price. Now, Victoria is looking like it is going through that sort of phase at the moment. But the key point I'm making here is every market within Victoria is going to be slightly different on that market cycle, right? Bendigo, Ballarat, Geelong probably not so much included, but Bendigo, Ballarat, very close from that, between that sort of rising and that boom sort of cycle, right? And this is where the crazy, FOMO starts to set in and we start overpaying. This is why I'm cautioning you, the buyers out there, against that. But there are some other amazing markets in Victoria, some of which I know what we're buying there at the moment, which are really only opened up in the last sort of couple of weeks, that we're seeing some amazing deals, getting them at amazing prices. There's not much competition. Right now, this is where you stay on the leading edge of these particular markets, because I always want to place my investors in a rising market so they can ride the wave, never at the peak and never truly at the bottom. Right, I need to see a bit of growth first, place the investors, and then they sort of ride that wave up. But just the key point to take away is that every market, every city, every state, every region, every town is going to move slightly differently. And you've just got to keep your finger on the pulse with where they are on the cycle. So let me give you some examples of that demand concentration, wave that we saw. Logan, amazing example of buyer's agent concentration, amazing example of data-driven investment concentration, and an amazing example of a lot of people entering late into that market, buying in Logan for $700,000-800,000, which I never did for any of my investors, but I could see a lot of people doing. And it's like, hang on, what? These property prices were like 300-something thousand just a fucking year and a half, 2 years ago, not even. And now you're paying double just to get into that market because you've seen all this growth occur. So that was sort of the 2020, 2022 type thing. Then we had the Adelaide North wave, the Playford, Elizabeth sort of region wave, very cheap market in Adelaide, huge buyers agent concentration, huge data-driven investment concentration in the 22 to 24 sort of phase. Bendigo, Ballarat, in more recently, you've got Rockingham, Mandurah, again, big buyers agent concentration, which really compressed that market cycle in these particular markets. So the main point here is that we need to be conscious of what information we're getting and from where. There is a lot of obviously the content out there that I know all of us watch. I think the content needs validating, right? My stuff, validate what I'm saying. Don't just take it on face value and go and make decisions on that. See for yourself, like jump on the phones, right? Speak to people, don't just look at what the data is saying, right? I say this, and I'm going to do another podcast on this, but just looking at the highest growth suburbs, like don't just do that because the growth has already occurred there. Where is the data actually coming from? Because there is a lot of stuff out there. Be cautious of social media, scrolling, through social media, and you just land on some random clip that might be talking about a particular part of, property investing, and it might sort of, inspire you or might even scare you, right? So we've just got to take things with a grain of salt. And I like to say this with a lot of things in life: trust but verify with anything that you're doing, and particularly when it is such a big financial decision like buying a property. It's probably one of the most expensive things any one of us are going to buy, right? So the important thing is you don't want to buy at the peak. You also don't want to buy right at the bottom. You want to buy when there's a little bit of growth, there's a little bit of momentum, and you can ride that wave through to the top of the market. So the real risk for investors is buying when the wave is already obvious. Again, throwing back to Ballarat, Bendigo right now, there is an obvious increase in public interest, an increase in buyers, agents. Again, great for the people that are in the market already. Not great for people looking to enter into that market because there are other areas within Victoria, for example, that are sort of where Bendigo, Ballarat were maybe, a year, 2-3 years ago. So there's a lot of, it's very easy to get caught up in that late hype, right? Like I see people right now wanting to buy into Townsville and Rockhampton and all that sort of stuff. And it's like, yeah, we were buying there too for a while, and we had some amazing deals, and there would still be some amazing deals there. You just need to be able to find them. But the reality is the general public buying general deals that are online, they're going to be overpaying, significantly over asking price to get into that market. Like Rockhampton, for example, it's not uncommon to pay 50, 60, 80, 100 grand over asking just to get into that market, just so you can be like, I'm in Rockhampton, this area is growing. It is still going to grow. Don't get me wrong. It's not like it's going to collapse, but that doubling the property price in the next sort of 2 years, highly unlikely. Why? Because it's already happened. So we've just got to be cautious about entering in that late hype phase. And again, if you need help entering into the market so you don't make that mistake, that's what we specialize in, finding the right market that fits you, not the general public, not the market that suits me, the market that suits you, because there is a market for everyone out there. You've just got to be able to find it. And if you want to, if you're on YouTube, there's a link in the description below to book a call. Doesn't cost you anything. Now, here's how you can position yourself early, right? If you're seeing it on TikTok, if you're seeing it on, a podcast, or basically if you're seeing it on social media, if you're seeing it in the news, it's already too late. Forget about it, right? You want to be able to find these markets before they become social media famous, right? You've got to look at land value fundamentals, okay? Be willing to look where no one else is looking yet. Like I mentioned earlier, right? I'm buying in Victoria, but I'm buying in markets that have no competition or little to no competition in them. This is where you're able to buy below asking price, and buying below asking price is typically buying below comparable sale, or what you'd commonly hear, buying below market value, right? That's how you make money in property, not buying into these hype markets. So you've got to go where the demand is forming. So think supply-demand imbalance. You've got to go where the market is going to move next. So where will the cluster of the general public go next? And it's not difficult to see. Now, obviously, I'm a buyer's agent, so maybe being a little bit naive with thinking that everyone can see that. But if you're able to do the research yourself, you can uncover these markets very, very efficiently. Maybe not easily. It does take time, does take effort. Obviously, that's why we have our service that we provide to clients. But if you want to do it yourself, you can. You don't need a buyer's agent to do this. So there's a fundamental change in how the Australian property market is going to is shifting and changing. it's going to be very interesting to see the next few years fallout from, you know, the Townsvilles and these other the Toowoomba's, these other overheated markets that have primarily been driven by buyers agents. And hey, maybe it's not all bad, and I hope it's not all bad, right? I hope that, you know, the areas that you know, every investor has got into does what they are expecting it to do, whether it's to cash flow, whether it's to grow. I really don't wish, you know, that anyone has, you know, bad fortune with property. All I'm really suggesting here and offering is that things are changing. They're changing quite quickly, changing quite rapidly. The more buyers agents enter the market, things are going to shift and change. And that means that we as investors need to think and shift and change with that as well. So constantly just looking at, you know, what has happened doesn't indicate what is going to happen. So that's my thoughts on property market cycles, where it's at, how it's shifting, how it's changing, some things you can look out for. If you got some value out of the episode, appreciate a thumbs up, consider subscribing. We drop the property podcast every single week on YouTube and Spotify. You can follow us on social media. We've got content coming out every single day. Instagram, I think, is the most common one we use. I don't fucking like TikTok. I don't know, man. I'm just too old for that shit. I'll get my team to post on there for you so you can see if you like TikTok, but not my thing. That's all we have time for. Appreciate you watching. Appreciate the client that inspired this episode as well. Shout out to you guys. You've got a sick property. Really happy with that. And look, again, if you need help on your journey, reach out in the description. Get in touch. More than happy to help. Until next time, thanks so much for watching. I'm Nick V, the director of the Smash Property Investing Buyers Agency, and I'll catch you soon.